Okay, so let's start. In our previous class, we discussed how to compute what we were calling the basic earnings per share. In the previous lesson, we discussed how to compute what we were calling the basic earnings per share. Today, we want to discuss the second type of earnings per share, which is called the diluted earnings per share. The diluted earnings per share. Okay? So for purpose of illustration, let me assume that your company, by end of this year, they had earnings attributable to ordinary shareholders worth 10 million. Okay? By the end of the year, they had 2 million number of shares. 2 million number of shares in the company. So it means, therefore, that the basic earnings per share of your company is 10 million, divide that by 2 million, that is 5 shillings. That is the basic earnings per share. That is your basic earnings per share. Now listen. But it may happen that by the end of the year, your company could have some financial instruments which are likely to give the owners of such instruments the opportunity to own ordinary shares in the future. Your company could be having some financial instruments by the end of the year which are likely to give the holders of such instruments the opportunity to own ordinary shares in the future. Listen. They don't own ordinary now, but it is possible they can get ordinary shares in the future. Those financial instruments are likely to give the owners the opportunity to own ordinary shares in the future. Listen, when your company has such financial instruments which are likely to give the owners the opportunity to own ordinary shares, then you as a company, you are required by IS number 33 that over and above you computing your basic earnings per share, you should compute what we call diluted earnings per share. You should also compute what we call the diluted earnings per share. Okay? Now we want to ask ourselves, what are these kind of financial instruments which are likely to give the holders the opportunity to own ordinary shares in the future? One of them is what we call convertible debentures. Convertible debentures. So if your company by the end of the year have convertible debentures, which I'm assuming maybe they are 10% convertible debentures amounting to 10 million, then we are saying these are instruments that will give the holders the opportunity to own ordinary shares in the future. They have not been given yet, but it's likely that they will be given ordinary shares in the future. Now, let us assume that you as a company, when you were issuing the debentures many years ago, you had promised the debenture holders anytime they want to convert their debentures into ordinary, let us assume that you promised to give them 1 million shares. You promised to give them 1 million shares. 1 million shares, okay? So, listen now. So assuming the day we issued the debentures, many years ago, had they converted the debenture holders, had the debenture holders converted, they have not, but had they converted, my question is, would our earnings per share still be 5 shillings? Would our earnings per share still be 5? The answer is no. Why? Because our number of shares would have now changed. Even the earnings would have changed. And therefore, listen, IS number 33 requires that if your company has such instruments, then by end of the year, you compute your actual earnings per share, which we are calling the basic. You also compute another earnings per share, which we call the diluted earnings per share. This diluted earnings per share is the earnings per share that would have been the earnings per share, had they converted, they have not converted, but had they converted, what would have been the earnings per share? It would have been a different amount, not 5 shillings. That which should have been the earnings per share, that which would have been the earnings per share, is now what we call the diluted earnings per share. We shall discuss how to compute it, but now we just want to know what are these kind of financial instruments which are likely to give the holders the opportunity to give give the holders the opportunity to own ordinary shares in the future. One of them is convertible debentures. Okay? Listen. When they will convert, listen, your company will not ask the debenture holders to bring in more cash into the business. When they will convert, the company will not require the debenture holders to bring in more cash into the business, no. But in that future, the moment they will exercise their right and convert the debentures into ordinary, your company will give them ordinary shares, meaning they will be given for free. They will be given for free. Remember, these debenture holders bought debentures many years ago. They bought debentures. They never bought ordinary. They bought debentures. But in the future, when they want to convert their debentures into ordinary, they will be given ordinary shares. But there will be nothing they will bring into the business in terms of cash. There is nothing they will bring into the business in terms of cash. Therefore, they will be given for free. And therefore, listen, and therefore we say, listen, because they will be given some shares for free, listen, because they will be given some shares for free, these debenture holders will dilute, listen now, will dilute the earnings of the existing or the original shareholders. They will dilute, the debenture holders will dilute the earnings of the existing ordinary shareholders. Why? Because they will be given more shares for free. And therefore, they will dilute our earnings. We as existing shareholders, we bought our shares at full market price. We bought our shares at a price. But now here are the debenture holders who will be given some shares for free. That automatically means they will dilute our interest in the group. In other words, in the company, they will dilute our earnings in the group. And therefore, you as a company, you are required to compute that which we are calling the diluted earnings per share. Okay? Now, there are many other instruments which are likely to give the holders the opportunity to own ordinary shares. I've only listed one, that is called the convertible debentures. The second kind of financial instrument which is likely to give the holders the opportunity to own more shares in future is what we can give as an example of a convertible preference shares. Convertible preference shares. Again, let us assume that your company has a 10% by end of the year. By the end of the year, your company has a 10% convertible debentures, convertible preference shares amounting to 10 million. Again, in future, if these preference shareholders want to convert their preference into ordinary, they will be given some more shares for free, and therefore they will dilute the interest of the existing shareholders. They will dilute the interest of the existing shareholders. That's another financial instrument. We shall talk about that in a short while. The other one is what we can call stock option. Stock option. You remember when we were discussing the basic earnings per share, we said what are stock options? We said stock option is a privilege given to employees of the company to buy shares at a price below the market price, where we were saying, for example, your company could have given the privilege to employees to buy 1 million shares at a price of 15 shillings when the market price could have been 20 shillings. So I hope you still remember. Listen, I hope you still remember we said when shares are issued as a result of a stock option. I hope you remember we said some of those shares issued are deemed to be issued at full market price. Some of them are deemed to be issued as bonus. Some of them are deemed to be issued as bonus. That is for free. When shares are issued, we talked about that in the previous class, that we said when shares are issued as a result of a stock option, some of those shares are deemed to be issued at full market price, and some of them, we said, are deemed to be issued as bonus. That means for free. So suppose by the end of the year you had given the privilege to the employees to buy extra shares, to buy shares in future, but to come the end of the year, they have still not exercised. They have still not exercised. They have not yet exercised. So we still have an agreement with the employees that in the future, they will buy 1 million shares at a price of 15, which is at a price below the market price. Remember now, listen, in that future, they will be given some more shares for free. Some of the shares will be given to them for free, and therefore they will dilute the interest of the existing shareholders. They will dilute the interest of the existing shareholders. So another instrument that can likely dilute the earnings of the existing shareholders is what we call stock option. If by the end of the year your company still has a stock option which the employees have not yet exercised, then it can dilute the interest of the existing shareholders. Okay? Another instrument is what we call partly paid shares. Another thing that can dilute the interest of the existing shareholders is what we call partly paid shares. Partly paid shares are also considered to be dilutive. For example, you as a company, you issued some shares at a price of 20, at a price of 20 shillings, at a price of 20, but come the end of the year, the shareholders have only paid you 15. The shareholders have only paid you 15 by the end of the year. It means in the future, they will pay you the balance of 5 shillings per share. There is a possibility that in the future, they will dilute the interest of the existing shareholders. We shall discuss that in a short while. How they will dilute, we shall discuss it in a short while. Okay, that's another instrument. Okay, these factors, listen, these factors that are considered or will dilute the interest of the existing shareholders, we normally refer to them as potential ordinary shares. We normally refer to them as potential ordinary shares. So we have so far listed 4 kinds or 4 types of potential ordinary shares which are going to cause dilution in the future. One is the convertible preference, convertible debentures, stock options, partly paid. By the end of the year, if your company has some partly paid shares, then they can be considered to be dilutive, and therefore they are called potential ordinary shares. The last one is what we call contingently issuable shares. Contingently issuable shares. Now listen, there are some companies which promise, especially their managers, they may tell their managers, if the price of the company shares exceed this much, or if the profit of the company exceeds this much, then you as managers, you will be given some shares. Listen, the condition is you must ensure that the target has been met for you to get such shares. If the target is not met, then you don't qualify to get such shares. So those kind of shares which are going to be given on condition, on certain conditions, we call them contingently issuable shares. And by definition, therefore, we normally say contingently issuable shares are those shares which are to be issued, when certain conditions are met. When certain conditions are met. I've given you, for example, if the market price of the company shares hits a certain amount, or maybe your profits exceed a certain amount, the company has promised their managers they will get this much. They will get this much number of shares. So by the end of this year, listen, by the end of this year, your company has such an agreement with your senior managers that they are going to be given maybe 1 million shares in the future if the profits exceed a certain amount. So this is again another instrument that is likely to dilute the interest of the existing shareholders. Remember, in that future, the managers will not be required to pay an extra coin, no, but they will be given 1 million shares for free, or whichever number of shares, they will be given another number of shares for free. And therefore, we are saying those are going to dilute the interest of the existing shareholders. Good. So these are what we can call potential ordinary shares, or some books will call them dilutive factors. We also call them dilutive factors. We also call them dilutive factors. What are those dilutive factors? The dilutive factors include convertible debenture, convertible preference, stock options, partly paid shares, and maybe contingently issuable shares. Contingently issuable shares. So we want to go through each one of them. We want to go through each one of them and see how do we use them to compute. How do we use them to compute what we call the diluted earnings per share? How do we use them to compute what we call the diluted earnings per share? So let me go through each one of them. So let us first assume a certain amount of the basic earnings per share. Let us assume your basic earnings per share was, let's assume by the end of the year, again, your company had earnings of 10 million, not 10 million earnings. 10 million were your earnings, but the number of shares were 2 million. So your basic EPS, was 10M divided by 2M, that comes to 5. That comes to 5. Okay? That comes to 5. Listen. But at the same time, by the end of the year, your company had a 10% convertible debenture worth 10 million. Many years ago, your company issued a 10% convertible debenture. Okay? Your company issued a 10% convertible debenture. Okay? You promised your debenture holders, in case they want to convert their debentures into ordinary, we shall give them 1 million shares. We shall give them 1 million shares. Now, let us assume the following is the income statement, part of the income statement of this company. You have what we are calling profit from operations. Let us assume it's 11 million. 11 million, that's your profit from operations. Then you have what we call finance cost. Finance cost, which is an amount of 10%. Finance cost is the interest your company paid. Don't forget, your company has a 10% convertible debenture worth 10 million. So this year, the company must have paid interest of 1 million. So that is 1 million. That gives us profit before tax of 10 million. Then your company had tax of, let's say, 30%, and that gives us 3 million. That gives me what we call profit after tax. What we call profit after tax, of 7 million. Okay. Then your company had dividends. Dividends, let's assume preference, 1 million. Ordinary, the company paid them 2 million. So your company retained, your retained profit was, maybe this is 4 million. Okay, so let's assume now you are required to compute now. Listen, let me change something here. So let me assume now you are required to compute the basic earnings per share. Last time when we were computing the basic earnings per share to December, listen, when we were computing the basic earnings per share, we said, how do we get the basic earnings per share? You remember, we said to get the earnings per share, you normally take, listen, you normally take the net profit after tax and you minus what? We said, how do you get the earnings attributable to the ordinary shareholders? We said, you get the net profit after tax, okay? You get the net profit after tax, and you less what? To get the earnings, which we were calling the net earnings per share, it is we take the net profit after tax, we said you less what? We said you less preference what? Dividend. You less preference dividend, and then we said you divide that now by what? By what we were calling the weighted average number of what? Number of shares. Weighted average number of shares. So let's compute from this company. Let's compute from this company what is their actual basic earnings per share. Their basic earnings per share. So you go to this company, find out what is the earnings attributable to the ordinary shareholders. We know to get the earnings attributable to the ordinary shareholders, you take the net profit after tax and you minus preference what? You minus preference dividend. You minus preference dividend, which in our case it is, how much? It is an amount of 7 million is the profit after tax. You less preference dividend, which is 1 million. And that gives you earnings attributable to the ordinary shareholders as 6 million. Okay? We said you take the net profit after tax, you minus preference dividends, that gives you the earnings attributable to the ordinary shareholders. Then you divide that now by what we were calling the weighted average number of shares, which for now we want to assume the weighted average number of shares are 2 million. So the current earnings per share, which we are calling the basic EPS of this company, is 3 shillings. Listen, it is 3 shillings. But many years ago, listen, many years ago, your company issued a 10% convertible debenture worth 10 million. Listen, your company issued a 10% convertible debenture worth 10 million. Listen now. Had the debenture holders converted, not that they have converted, listen, not that they have converted, but had they converted the debentures many years ago, when we issued those debentures, listen, it automatically means that the earnings attributable to the ordinary shareholders, would no longer be 6 million. Why? Had the debenture holders converted, we as a company, our earnings this year would not have been 6 million. What would have been the earnings? It is obvious our earnings would have been more than 6 million. Why? Listen to this now. Why? Because this year, we as a company, we paid our debenture holders. An interest of how much this year? 1 million. I hope you can see it. We paid them an interest this year of 1 million. That is the finance cost. which is 10% of the 10 million. That's what we paid. Listen. But I'm saying, had they converted, who? The debenture holders, had they converted their debentures into ordinary, we as a company, we would not have paid them this year 1 million. We would not have paid them 1 million. Listen now, we would not have paid them 1 million. Instead, we would have saved that 1 million. Had they converted maybe last year or when we issued the debenture, in the current year, we as a company, we would not have paid them that extra 1 million that we paid them this year. No. So we as a company, we would have saved it. Meaning therefore, what would have been, listen now, what would have been the profit after tax? Currently, the profit after tax is 7 million. But what would have been the profit after tax of this company had they what is the profit after tax had they exercised the right and converted? In other words, listen, I would have saved the dividend interest. I would have saved dividend interest of 1 million. Suppose this interest of 1 million is not in the income statement. What would have been our profit after tax? I want you to watch now. Our profit from operation is still 11 million. Let me put it in thousands. Our profit would still be 11 million. We would have saved that interest. We would have saved it because we would not have paid them this year. I hope you are following. We would not have paid them this year. Why? Had they converted the debentures the moment we issued them the debenture, this year we would not have paid it. In other words, we would have saved it. Okay? Then now we are saying our profit before tax would have been 11 million. Okay? But our tax would still remain 30%. 30% of 11 million, you can see, is 3.3 million. 30% of 3 million, of 11 million, 30% of 11 million would be an amount of 3.3. So that means automatically our profit after tax would have been 7.7. That is the profit after tax. Okay? Then, once I get the profit after tax, I minus the preference dividends, which is still 1 million. We paid preference dividends this year. Or maybe, let's put it this way. Let us also assume, by the way, that will be easier. Let us assume there was no preference. Let us assume that there was no preference. Maybe I can even make the work simpler. I can make the work simpler this year. Let me assume there were no preference. That is even better. Let me assume there was no preference. Good. Let me change. Let me assume, listen now. Let me assume there was no preference. It will be better. It will be better. That is what I want to assume. Now listen. So if the company did not have any preference dividends, preference shares, therefore the basic EPS would have been, take the net profit after tax minus preference dividends. Your company doesn't have preference shareholders, so our earnings attributable to the ordinary shareholders was 7 million. Then you divide that by the number of shares, which is 2 million. That gives me earnings of 3.5. Good. The earnings per share, basic, would be 3.5. Good. Now listen. Now we are going on and saying, suppose those debenture holders had converted. If the debenture holders had converted, that time when we issued the debentures, we would have saved their interest. We would have saved their interest. We paid them this year because they had not converted. But had they converted this year, we would not have paid them their debenture interest. In other words, we would have saved it. So what would have been the profit after tax if they had saved? We are seeing that profit after tax would now be 7.7 million. Listen now. Meaning the earnings attributable to the ordinary shareholders would now have been 7.7 million. 7.7 million. Listen, that's what we are saying. 7.7 million. But we had promised them, if they want to convert their debentures into ordinary, I will give them 1 million shares. We shall give them 1 million shares. Listen now. Currently, our shares are 2 million by end of this year. But had they converted when we issued those debentures, our number of shares by end of this year would no longer be 2 million, but would be how much? 3 million. Good. That means you'd mean our number of shares would be 3 million. Listen to this now. It means, therefore, if the debenture holders had converted, their debentures into ordinary, our earnings per share, listen now, our earnings per share would no longer be 3.5 as it is currently. It will be how much? Somebody with a calculator, how much would it be? What is the amount? Take that 7.7, take that 7.7 million, you divide that by, take that 7.7, you divide that by 3 million shares. So it means our earnings per share, now listen, would have been 2.57. 2.57. Listen. So we are saying, listen carefully, if the debenture holders had converted, they have not, but had they converted, then our earnings per share would not be 3.5, but would be diluted to how much? To 2.57. So that 2.57 is now what we call the diluted EPS. Is now what we call the diluted EPS. Listen now. So we are saying, when your company has a convertible debenture by the end of the year, listen, when your company has a convertible debenture by the end of the year, your company will be required to compute what we are calling the diluted earnings per share. How do we compute it? Listen, I hope you have noticed that, listen, I hope you have noticed our basic earnings per share was 3.5. We got it by taking 7 million, which was the earnings attributable to the ordinary shareholders, which I can see up there, 7 million. This company, we are assuming, did not have preference shares, so there was no preference dividend. So it's just profit after tax, divide that by the weighted average number of shares, which is 2 million. Okay? That gives me 3.5. Good. Now listen. Then, now that our company has convertible debentures, it is obvious, listen, I'm saying, listen, it is obvious our company would have saved the interest we paid them. We paid them this year interest of 1 million. I hope you can see it up there as the finance cost. But, listen, but though we would have saved interest of 1 million, I hope you are saying, listen, though we would have saved interest of 1 million, our earnings attributable to the ordinary shareholders will not increase by 1 million. Listen, will not increase by 1 million, but instead would have increased by how much? I hope you can see it has only increased by 700. From 7 million to 7.7. Meaning now, listen, meaning now that our earnings, I hope you are following, our earnings will increase by the amount of the debenture interest saved, listen, by the amount of the debenture interest saved, net of what? Net of tax. Listen, our tax rate is 30% from this illustration. We would have saved interest of 1 million. So effectively, our earnings should have gone up by 1 million. But because interest is subjected to tax, we are now not saving exactly 1 million. We are only saving we are saving 700 amount. We are saving only 700 out of the 1 million. Listen, so our earnings would increase by what we are calling interest paid net of tax. Okay, our tax rate is 30%. So I take 1 million, I get 30% of it, I now remain with a balance of 700. So our interest will increase, our earnings will increase by the amount of the interest saved. That's the point I want you to get. By the amount of the interest saved net of tax. Net of tax. Okay, that's what we are saying. So to compute, listen, now to compute what we are calling the earnings, you will take that 7 million, you add that 1 million that you would have saved, net of what? Net of tax, which in simple, you can say 1 minus what? 1 minus 0.3, which is the tax rate. This 0.3, it is the tax rate, okay? So which means it will be 7 million plus what? In simple, if you know the basic earnings, the earnings for the basic, 7 million, and you know you paid the debenture holders 1 million interest, that earning of 7 million will increase by the number or by the debenture interest paid net of tax, which is 1 million. Take 70% of that. That comes to 700. So your earnings will be 7.7 million. Then you divide that by, previously, our earning number of shares were 2 million. But we had agreed with the debenture holders, if they want to convert, we shall give them 1 extra million shares, 1 million shares. Okay, so we are saying the number of shares now would have increased by the 1 million shares. So our number of shares, if they had converted, would have been 3 million. And that's what we are getting. The earnings per share would have been 2.5 what? 7. 2.57. So in simple, listen now. In simple, when you are computing the diluted earnings per share and your company has a convertible debenture, listen, as we summarize now, we are saying you take the earnings used for basic EPS, which is 7, then you add debenture interest that would have been saved net of tax. You take the earnings used for basic EPS, whatever the question will give you, then you add debenture interest that would have been saved net of tax. I hope you are following. Then I've said, to the number of shares used for basic EPS, which is 2 million, now add to that the number of shares to be issued. The number of shares to be issued on conversion. The number of shares to be issued on conversion. Whatever the question will give you. That's what we are saying. Okay? Now, before we leave that one, now listen. I have assumed your company had earnings of 7 million by the end of the year. The number of shares were 2 million. That has given me the basic EPS of 3.5. Now listen, I have assumed that these debentures were issued many years ago. In other words, we are assuming the debentures were there as from the beginning of the current year. The debentures were there as from the beginning of the current year. The convertible ones. They remained convertible up to the end of the year. Nothing has been converted. But listen to this now. But what if your company had issued the debentures in between the year? Maybe on 1st July. That's when your company issued a 10% convertible debentures worth 10 million. Listen. if your company had issued the debentures in between the year, listen carefully now, it means that you as a company, you never paid your debenture holders interest for the whole year. You never paid them interest for the whole year. So in your income statement, whatever it was, in your income statement, it is obvious you must have only charged interest for 6 months, from July to December. And therefore, listen, and therefore, to compute the diluted earnings per share, you will take whatever you used as the earnings for basic EPS, then you add the interest that would have been saved net of tax for those 6 months. For those 6 months, not the whole year. Remember, the rate is 10% of 10 million for 6 months. You must have paid them this time 500, which is 0.5. That is what you paid them, because the debentures were issued in between the year. And therefore, we are saying you must have paid them interest of 500. But again, I've said, because interest is subjected to tax, then if your earnings, let us assume the earnings were 7 million, for purpose of basic, I'm assuming the earnings were 7 million, to that 7 million, you would have added, you would add the interest to be saved net of tax. And what is the interest we paid? We paid interest of 500 for 6 months. Net of tax, which is 30%, nekusema, you take 70% of 500, which looks like 350. That is what you would add. So it means for purpose of diluted EPS, your earnings would have been 73.50. That's what I'm assuming, okay? Then you now divide this by the weighted average. Listen carefully. You divide this by the weighted average number of shares. For basic EPS, our number of shares were 2 million. Listen. We have promised the debenture holders, when we were signing this debenture, when we were signing this agreement with the debenture holders, which was on 1st of December, we promised them anytime in the future they want to convert, we shall give them 1 million shares. We shall give them 1 million shares. Listen, had they converted the debentures, had they converted the debentures on 1st of July when we issued them, then the number of shares would not have been 2 million at the end of the year. Listen, the number of shares would not have been 2 million at the end of the year. No, it would have been different. So I take plus, listen, plus the 1 million shares I would have issued them. But you remember we talked about this when we were discussing basic EPS. We said, the rule says, when shares are issued on conversion, they must be weighted on time basis. They must be weighted on time basis. Listen, had the debenture holders converted on 1st of July, they would have been my shareholders for only 6 months. They would have been my shareholders for 6 months. Yes, listen, yes, I would have given them 1 million shares, but then for purpose of earnings, we would have told them, you have not been my shareholder for the full year, or you will not be my shareholders for the full year. Why should I give you earnings for the full year? I'm going to give you only earnings for 6 months. So this number of shares would have to be weighted on time basis, which is 6/12. And therefore, listen, and therefore, for purpose of dilution, your weighted average number of shares would have been 2.5 million. You now divide that by 2.5 million. Before we go to the second potential ordinary share, as I summarize the debentures, I have said, when you have a convertible debenture by the end of the year, to compute the diluted earnings per share, I have said, to the earnings that you used for basic EPS, whatever the earnings you used for basic EPS, increase them by the amount of the debenture interest to be saved, net of what? Net of tax. I have explained that. Then I've said, to the number of shares used for basic EPS, add the number of shares to be issued on conversion. Okay? On conversion. Which was, in our case, 1 million, whatever it is. Then I've gone further. Listen to this now. I've gone further and said, if the debentures were issued many years ago, then, listen now, then the conversion is assumed. The conversion is assumed to be with effect from the beginning of the year. Meaning, you assume the debentures were there by the beginning, they would have converted by the beginning, and therefore I would have given them the full 1 million shares. Okay? Or I would have saved the same interest of 1 million, all of it. Okay? But if the debentures were issued in between the year, that's another key point. If the debentures were issued in between the year, listen, the conversion is assumed to be with effect from. The conversion is assumed to be with effect from the date of the issue. The date of the issue, which is 1st July. And therefore, you would increase the number of shares only by the number of shares that would have been given, but to be weighted on time basis. To be weighted on time basis. The interest, you would have only paid them for 6 months. If it's 3 months or 4 months, whichever the number of months, whatever it is. But the point is that if the debentures were issued in between the year, then the conversion is assumed. The conversion is assumed to be with effect from. The conversion is assumed to be with effect from the date of the issue. The conversion is assumed to be with effect from the date of the issue. Therefore, the shares must be weighted on time basis, that is 6/12, and the interest you would have paid them, you would have only paid them for 6 months. So I am now through with our first potential ordinary share called debentures. That one. I am through with it on how to use it to compute what we are calling the diluted earnings per share. To use it on how to compute what we are calling the diluted earnings per share. Take the earnings that you use for basic EPS, increase them by the debenture interest, net of tax that would have been saved on conversion. Then to the denominator, which is the number of shares, increase them by the number of shares that would have been issued on conversion. Okay? Then I've said, if the debentures were outstanding as at the beginning of the year, the conversion is assumed to be with effect from the beginning of the year. Then I've said, if the debentures were issued in between the year, then the conversion is assumed to be with effect from the date of the issue. I hope so. You have understood. Sawa. That's all. So let's go to the second one. And the second one is what we want to call convertible preference. So let us again assume your company began or had 2 million shares again by the end of the year. Your earnings were 10 million, or let's first assume. Let me first give you an income statement first. Maybe you have been given profit after tax. The profit after tax for your company is 10 million. You have preference dividends. This is dividends. For preference, let's assume it's 2 million. Then for ordinary, your company has paid dividends of 1 million. So that gives us 8 million. Listen now. So you are told to compute the basic EPS. Of course, you know, we have said basic EPS would be given by net profit after tax and preference dividend. Net profit after tax and preference dividend. Our profit after tax is 10 million. Preference dividends are 2 million. Maybe I could change so that we don't confuse. Let me change so that you don't confuse. Let me change here so that you don't confuse which 8 million I'm talking about. So let me assume the dividends on pre-ordinary were, let's assume 5 million. 5 million. So this company retained 3 million. Yes, good. So for purpose of basic EPS, we have said you take the net profit after tax and you less preference dividends to get what we were calling the earnings attributable to the ordinary. So for this company, the earnings are 8 million, which I hope you can see it is 10 minus the preference dividends of 2 million. Okay? That gives me 8. Divide that by the number of shares, which are 2 million by the end of the year. So currently, the existing shareholders have a basic EPS of 4 shillings. Listen now. The current existing shareholders have a basic EPS of 4 shillings. Listen. But by end of this year, our company has a 10% convertible debentures. No, convertible preference worth shillings 20 million. Your company by end of this year has a 10% convertible preference worth 20 million by the end of the year. Listen. These preference shares were issued many years ago. These preference shares were issued many years ago. So this year, we paid them a dividend of 2 million, which is 10% of 20 million. We paid them 2 million. If the preference shareholders had converted, listen, had they converted their debentures at their preference into ordinary, had they converted their preference into ordinary, this year, we as a company, we would not have paid them. We would not have paid them that preference dividend of 2 million. Remember, we would have saved it. So our profit after tax would still be 10 million. This time, I would not have paid preference dividends. No. Preference dividends would be dash. Ordinary dividend would have been still 500. No, this is 5 million. Meaning our company would have retained a profit of another 5 million. Now listen. It means therefore, listen carefully, it means therefore, if the preference shareholders had converted, our earnings attributable to the ordinary shareholders would have been how much? It is obvious the earnings attributable to the ordinary shareholders would have been 10 million, which is what? Net profit after tax, you less what? Preference. But don't forget, this time, had they converted the preference when I issued them many years ago, this year I would not have paid them any dividend. It is a dividend I would have saved. So our earnings attributable to the ordinary shareholders would have been 10 million. Don't forget, listen, this time I don't subject the dividend to interest like we have done for debenture interest. Why? Because dividend in the income statement is not subjected to tax. Dividends comes after charging tax. So we don't subject the dividend of the preference dividend to tax. It's not like interest. Interest was charged before the tax, and therefore interest was subjected to tax. Dividends are not subjected to tax. So which means we are saying, listen, my earnings would have increased. What you used for basic EPS, which in our case now is 8 million, we used 8 million for basic EPS. If the preference shareholders had converted, our earnings would have increased. Our earnings would have increased by the preference dividend. By the preference dividend that would have been saved on conversion. By the preference dividend that would have been saved on conversion. So that means you add to the 8 million, add the preference dividend, which is how much in our case? 2 million. Good. That gives you 10. Then we had promised them, if they want to convert their preference into ordinary, we shall give them 1 million shares. We shall give them 1 million shares. Now that they will convert, had they converted, our number of shares in the company come the end of this year would not have been 2 million as it is currently. Our number of shares would not have been 2 million as it is currently. Our number of shares by end of this year would have been 2 million plus the 1 million that we would have given to them. So it means our number of shares would have been how much? 3 million. I hope you are following. So it means now, if the preference shareholders, get my point, if the preference shareholders would have converted, our earnings per share would have been 10 million divided by 3. That looks like 3.3 shillings. So that is what we are calling the diluted EPS. In other words, you have diluted your earnings from 4. We will dilute our earnings from 4 shillings, which is the basic, to 3.3. So this is what we are calling diluted EPS. Diluted EPS. So that's what we are saying. Listen. So when you have convertible preference shares, I hope you are following. When you have convertible preference shares by the end of the year, to compute the diluted earnings per share, we are saying to the earnings used for basic EPS, to the earnings used for basic EPS, you add the preference dividend that would have been saved, the preference dividend that would have been saved on conversion, That is 2 million. You add the preference dividend that would have been saved on conversion. Then I've said, to the number of shares used for basic EPS, which in our case is 2 million, you add to that number, add the number of shares that would have been issued. They have not been issued, but add the number of shares that would have been issued on conversion, which in our illustration, we are assuming to be 1 million. So the number of shares would have been 3 million. So that which you get as your earnings per share now becomes the diluted earnings per share. So we are telling the existing shareholders, listen, we are telling the existing shareholders, currently you are earning 4 shillings per share, but it is possible your earnings could be diluted. Your earnings could be diluted to 3.3 per share. Your earnings could be diluted to 3.3 per share because of the convertible preference. Because of the convertible what? Preference. Good. Listen again. What if again your company had issued those preference shares in between the year on 1st July? If your company had issued the preference shares on 1st July, then it means this year you did not pay them the dividend for the whole year. It's not like ordinary, listen, ordinary shareholders get ordinary dividends for the whole year, whether they have been a shareholder for the whole year or not. For ordinary dividend, they normally get the dividend for the whole year, whether they have been a shareholder for the full year or 6 months or 2 months or 1 month. Doesn't matter for ordinary. But when it comes to preference, you are only paid dividend for the period your shares were outstanding during the year. So if the company had issued preference shares in between the year, that could be on 1st July, then listen, your company must have only paid them in a dividend for 6 months. So in that case, because they were only paid dividend for 6 months, then to the number of shares used for the amount of earnings used for basic EPS, add the preference dividend that would have been saved for those 6 months. Add it to the number, to the earnings that you use for basic EPS. So if your company had a 10% convertible preference worth 20 million, then how much did you pay for 6 months? It must have been 10% of 20 million times 6/12, which comes to about 1 million. That's what you paid for 6 months. That 1 million, you add it to whatever you used, for basic EPS, Okay? That is it. So that's how you do that. Then, again, on 1st of July, when we were issuing the debenture, the preference, we had promised them that if they want to convert the preference shares into ordinary in future, we shall give them 1 million shares. Again, if they had converted on 1st of July, they would have been our shareholder only for 6 months. So again, those shares that would have been issued on conversion, which we are assuming to be 1 million, again, they must be weighted on time basis. They should be weighted on time basis. Okay? That's how we deal with it. That's how we deal with that now. Good. So, meaning, you take the number of shares that were used for basic EPS, which in our case is 2 million, plus 1 million shares times 6/what? 6/12. Those 1 million shares should be weighted. So I am now through again with the second item that we call a potential ordinary share. And that is what we are calling the convertible preference shares. What have we said in summary? That if your company has a convertible preference shares by the end of the year, your company should also compute the diluted earnings per share. We have said to compute the diluted earnings per share to the earnings you used for basic EPS, add the preference dividend that would have been saved on conversion. In other words, what you paid them this year, which otherwise you would have saved it. Add it to the earnings used for basic EPS. Then I've said, to the number of shares used for basic EPS, add the number of shares that would have been issued on conversion. Okay? That's what we are saying, to get the diluted EPS. Then we have gone further and said, what if your debenture, your preference shares were issued in between the year? If they were issued in between the year, then the conversion is assumed. The conversion is assumed to be with effect from the date of the issue. The conversion is assumed to be with effect from the date of the issue, which is 1st July. So you must have paid dividends for 6 months. So those dividends you paid for 6 months are the ones who would have saved. The number of shares would have been issued in July, which is 1 million, but because they would have been our shareholders for 6 months, their shares to be issued must be weighted. The shares to be issued must be weighted on time basis. Good. So we are now through with the second item called potential ordinary share. That's what we want to go now. We are through with the second one called potential ordinary share, called the 10% convertible debentures. I want to go to the third one now and deal with the third item and how to use it to compute what we are calling the diluted earnings per share. And our third item is what we are calling stock option. Listen again. During the year, or your company by end of this year had 2 million shares. The earnings attributable to ordinary shareholders, which is the net profit after tax and preference dividends, were 10 million. So it is obvious your basic EPS was 5 shillings, which is 10 divided by 2 million, that is 5. Listen now. But your company had signed an agreement with its employees that they will be given the privilege to buy 1 million shares at a price of 15 when the market price is 20. These employees, come the end of the year, they have not yet, listen, they have not yet exercised that right. They have not yet exercised that right. So we still have, by the end of the year, we still have what we are calling a stock option, which will give the employees the privilege of buying how many shares? 1 million at a price of how much? 15 when the market price is 20. Listen. So, in future, the employees will buy 1 million shares by paying how much per share? 15 instead of 20. I do hope you remember when we were discussing basic earnings per share, we said if shares are issued on the exercise of a stock option, what happens? Suppose the company had issued the 1 million shares at 15 shillings. You remember we said when shares are issued on the exercise of a stock option, listen, some of those shares we said are deemed to be issued. How? At full market price, and some are deemed to be issued as how? As bonus shares. So when we were dealing with the basic EPS, we were separating that 1 million. How many of them are deemed to be issued at full market price, and how many of them are deemed to be issued as bonus shares? So, if you remember, you should be able to tell me, out of the 1 million shares, how many of the 1 million would be deemed to be issued at full market price? How many? Do that calculation. When we were discussing basic EPS, we applied that knowledge. It's the same knowledge I'm asking you to use. Out of the 1 million shares, how many of them will be deemed to be issued at full market price? How many? Yes. We say 750. Good. How are we getting 750? We were saying these employees, when they bought or when they shall buy, they will pay me 15 shillings per share on their 1 million shares. That means they will pay me 15 million shillings. They will pay us 15 million shillings. Listen, when they pay us 15 million shillings, we shall give them how many shares? 1 million. Because that's the agreement, that they buy the shares at 15. So if they were to buy 1 million shares, they will pay the company 15 million shillings. Listen, but then we said, if they are to use their 15 million to go to the stock market and buy the shares using their 15 million, they would not buy their shares at 15. They would find the market price being 20. So we said, it obviously means that their 15 million shillings would not be enough to buy 1 million shares. It would be enough to buy how many? If they are to use their 15 million to go to the stock market and buy the shares, they would buy them at 20. With their 15 million shillings, they would be able to buy only 750,000 shares. But, listen, the moment they bring in 15 million to the company, we shall not give them 750. The moment they bring 15 million to the company, we shall give them how many shares? Obvious, we shall give them the 1 million. But out of that 1 million, listen now, out of that 1 million, it is obvious 750,000 shares will be given to them at full market price. The balance, which is 250, that amount of 250 is what we were saying would be considered to be given to them for free. Would be considered to be given to them for free. And that is what we said, they will be considered to have been given for them for free as what? As bonus shares for free. Now listen. I told you, these potential ordinary shares, listen, these potential ordinary shares cause dilution. They cause dilution, listen, they cause dilution because shares will be given to those guys, whoever they are, for free. Shares will be given for free. Listen, if it was convertible debentures, they will come and exercise. The moment they will exercise, we shall give them for free shares. Convertible preference, when they shall come, we shall not ask them to pay us any extra coin. No, we shall just convert and give them the ordinary. These stock option employees, when they shall exercise, we shall give them another 250 for free. Another 250 for free. 750 will be given to them at full market price. Listen now. Which of these two components do you think will dilute the interest of the existing shareholders? Which of these two components do you think will dilute the interest of the existing shareholders? Guys will come into the future, they will buy 1 million shares. Out of the 1 million, 750 they will buy them at full market price. 250 will be given to them for free. So which of these two components do you think will dilute the interest of the existing shareholders? It is obvious, the ones that they are going to be given for free. Why? Because you existing shareholders, you bought shares at full market price. These guys will come and buy another 750 at full market price. Listen, that does not dilute the interest of the existing shareholders. The 750 does not dilute. But because these employees will be given another 250 for free, listen, because these employees will be given another 250 shares for free, it is those 250,000 shares that are going to be considered to be dilutive. It is the 250,000 shares that are going to be considered to be dilutive. Why? Because they will be given for free. While other existing shareholders bought theirs at full market price, these employees will be given 250 for free. Now listen. So, when you have, by the end of the year, if you have a stock option, listen now, to the number of shares you used for basic EPS. When we were computing basic EPS up or due, or up on top there, we saw our earnings were 10 million. The number of shares were 2 million. So our basic EPS was 5. Now we are saying, because the company has a stock option, to the number of shares used for basic EPS, when you are calculating the diluted earnings per share, listen, when you are computing the diluted earnings per share, you will take the number of shares for basic EPS 2 million, then you add only the bonus share element. Only add the bonus share element to the number used for basic EPS. So that will come to be 2250. I hope you are following. You don't add the 1 million because not all of them are dilutive. I told you, these potential ordinary shares are considered to be dilutive. Why? Because shares will be given for free. Shares will be given for free. Convertible debenture will be given for free. Convertible preference will be given for free. Now stock option guys will be given another 250 for free. Those shares are the ones that are going to be considered to be dilutive. Now listen. Our earnings were 10 million. Listen carefully now. These employees have not yet exercised the right and bought. We still have them by the end of the year as potential. Meaning, we still have an agreement with them that they can buy 1 million shares in the future if they want. But come the end of the year, they have not exercised yet. Listen, they have not exercised yet. Question is this: had the employees exercised their right and bought the shares the moment we signed with them the agreement called stock option? Had they exercised that right and bought the shares? Question is, would our earnings have changed? Would our earnings have changed? Currently, our earnings are 10 million. That is net profit after tax and preference dividends. But had these employees exercised the right the moment we signed the agreement, they have not converted yet, but had they had they exercised the right and bought the shares on the day we signed that agreement with them, would our earnings in this particular year have changed? Yes or no? In other words, would there be a change in the income statement? Because it's from the income statement that you picked your net profit after tax and preference dividends. If the employees had exercised the right and bought the shares with the 1 million, would our earnings in the income statement have changed? The answer is no. Why? Listen. Nothing will change in the income statement even if the employees had acquired. Why? Because the salary you have been paying them, you still pay them. Everything in the income statement will still remain the same. So even if they had exercised the right and acquired the shares the moment we signed that stock option agreement, our earnings for this particular year would not have changed. Listen. So we are now saying when you are computing the diluted earnings per share, listen, when you are computing the diluted earnings per share, our earnings that you use for basic EPS don't change. They would still remain 10 million. But then I've said, to the number of shares used for basic EPS, I have said you add the bonus share element, in the stock option. You add the bonus share element in the stock option. That is what you add. So in this case, your diluted EPS now will be how much? What is 10 million? Divide that by 2250. That comes to about 4.4. Remember, your basic EPS was 5 when we were computing it somewhere. Yes, there it is, 5. But we are telling the existing shareholders, it is possible your earnings could be diluted to 4.4 shillings if the employees had exercised their right and converted. No, and bought the shares. If the employees had exercised their right and bought the shares, then your earnings per share this year would not have been 5. Your earnings per share this year would have been 4.4. Good. So I'm now through with the third item, which we are calling stock option, as a potential ordinary share or as a dilutive factor. What have we said? That if by the end of the year you have stock options, then how do you use them to compute the diluted EPS? We have said to the earnings used for basic EPS, don't add anything. The earnings will not change. The earnings will not change. That's what we have said. Why? Because nothing in the income statement will do what? Will change. Then I've said, to the number of shares used for basic EPS, you add the number of shares which are considered as bonus in the stock option. In other words, to the number of shares used for basic EPS, you add the bonus share element. You add the bonus share element in the stock option. How many out of the 1 million are considered as bonus? That is, in our case, 250. Those are the ones you consider. Sour. Good. So now we are through with the third item. We want to go to the fourth item that we call that we call partly paid. I think that's the one. Let me confirm. Yes, we are through with the third one now, which is this stock option. Now we go to partly paid shares. How to use them as to compute what we are calling diluted EPS. So let me talk about them first. And that's what we are calling partly paid shares. How are they considered to be dilutive? How are they considered to be dilutive? That's what I want to talk about now. Okay? So let me explain it. Your company had issued, listen, your company had issued 1 million shares on 1st January for 20 shillings, but come the end of the year, the company had only been paid 15 bob. We issued shares at market price of 20, but the company was only paid 15 shillings. So, assuming the earnings were again 10 million. 10 million. The earnings attributable, that's the net profit after tax. So when you are computing the basic EPS, what did we say? Remind me, what did we say when shares are issued and they are partly paid? When we were computing basic earnings per share, what did we say when shares are issued and they are partly paid? How do you use them for basic EPS? What did we say? For basic EPS, what did we say? For basic EPS, what did we say? When shares are issued and they are partly paid, listen, we said you consider them. Hope you remember, you consider them only to the extent that they have been done what? Only to the extent that they have been fully paid. I hope you remember that point. When shares are issued during the year, or when shares are issued and they are partly paid, for purpose of basic EPS, we said consider them only to the extent that they are fully paid. Only to the extent that they are fully paid. In other words, like in this case, we issued 1 million shares. I'm assuming we issued them at the beginning. We issued them at 20 shillings, but come the end of the year, the shareholders had only paid us 15. So when I'm computing the basic EPS, I only consider out of the 1 million, how many of them are deemed to be fully paid? How many of them are deemed to be fully paid? Okay? So maybe we can even assume something like this. Listen, we had 2 million shares by the beginning from many years ago. Let's assume that way. We had many shares many years ago, 2 million. Come January this year, we issued another 1 million at 20 bob. But come the end of the year, they have only paid me 15 on the 1 million. So when I'm computing the weighted average number of shares for basic first, we are saying out of the 1 million you issued, which are partly paid, how many of the 1 million are deemed to be fully paid? In other words, we said how many of the 1 million will participate in dividends? We said, how do you get it? You take 1 million times 15, which is what they have paid us so far. That comes to how much? 15 million. Divide that by the market price, which is 20. So tukasema, listen, out of the 1 million shares, 750,000 shares are deemed to be fully paid. Listen, when they brought in the 15 million, because they have only paid me 15 million, I issued to them 1 million. Don't forget, listen, I issued to them 1 million. Out of the 1 million, only 750 will participate in dividend. In other words, only 750 are considered to be fully paid. And I said, when shares are partly paid, for purpose of basic EPS, consider them only to the extent that they are fully paid. Only to the extent that they are fully paid. Okay? So when you are computing the basic, you took 2 million shares that were there by the beginning from many years ago, plus, now not the 1 million, plus the 750. Remember, this money came in January. So the money must have financed you for the whole year. So this time, you don't multiply by 6/12 like you were doing when we were issuing the shares in July. If, of course, the 1 million shares were issued in July, then I would have multiplied the 750 by 6/12, just like we were doing. But now we are saying this money that they gave me, 15 million, came in January. So the money financed me for the full year. So for purpose of basic, utatumia how much? Utatumia 27 what? 50. Our earnings were 10 million. So basic EPS would be 10M, divide that by 2,750,000. How much does it give me as the basic EPS? 10, divide that by 2.75. That gives me 3.6364. Let's put it that way. Okay? 3.64. That is the basic. You have taken the number of shares that were there by the beginning, 2 million. You have added the number of shares out of the 1 million that are considered to be fully paid. That is 750. Because the money came in January, there was no time factor. Otherwise, had we issued them in July, I would have multiplied by 6/12. I hope you remember that point. So our basic EPS is 3.64. Now listen. Listen now. In future, I want you to listen carefully now. In future, these shareholders will pay me the balance of 5 shillings per share. I issued the shares at 20. Now listen. I issued to them the shares at 20 bob, but so far they have only paid me 5 shillings per share, 15 per share. So they are yet to bring into the company another 5 shillings per share. On the 1 million shares, listen, on the 1 million shares, they are yet to bring into the company 5 million shillings. Carefully listen. When they shall bring in the 5 million, when they shall bring in the 5 million shillings in the future, listen, as a company, we shall issue to them the balance of their shares so that they participate in dividend fully now. Listen, so far, they have only paid me 15 shillings per share. So out of the 1 million, not all of them are participating in dividend, only 750 that are fully paid. Follow carefully. But I'm saying, once they bring in the balance of the 5 million shillings, then as a company, we shall issue the balance of the shares, which are to 50,000, so that now the whole 1 million can participate in dividend. Hope you are following. When shares are issued and they are partly paid, I said, consider them only to the extent that they are fully paid. In other words, only to the extent that they will participate in dividend. So out of the 1 million shares we issued, not all of them will get dividend during the year, only 750. And those are the ones we use for basic EPS. Then I've said, when they shall bring in the balance of 5 million shillings in future, they have not. By the end of the year, they have not. But when they shall bring in the balance of 5 million in future, listen, then as a company, we shall now issue the balance of the shares again to the extent that they are fully paid. Listen carefully now. Listen carefully. Suppose they had brought their 5 million at the end of the year. Listen, but at that end of the year, the market price per share now is no longer 20. The market price per share is no longer 20, but the market price per share is 25. Listen carefully. These shareholders will bring in the balance of their 5 million in future. I will give them as a company the balance of their shares. How many? 250. But suppose they will bring in the 5 million. Listen, suppose they will bring in the 5 million when the market price of the company shares has increased now from 20 to 25. Listen, it means if they were to use their 5 million shillings, which they will bring, if they were to use their 5 million to go to the stock market, they would find one share being sold at 25. Follow now? So, with their 5 million shillings, if they went to the stock market, they cannot buy to 50. They can only buy how many? These guys will bring in 5 million. Suppose they had brought in 5 million at the end of the year, but at that end of the year, maybe the market price has gone up from 20 to 25. It means if they had brought in the 5 million, and if they took their 5 million, and went to the stock market to buy the shares, they would buy one share at 25. So they can only buy how many shares? 200. Listen carefully now. If they were to use their 5 million balance to go to the stock market, they can only buy 200,000 shares. But the moment they will bring in the money to the company, we shall have to give them the balance of their shares, which is 250. Because we agreed, buy 1 million shares, pay me part of the money, 15, bring the balance in the future, 5 shillings. So I have said, the moment you paid me 15, to that extent, you only use 750,000 shares of yours to participate in dividend. When you will bring in the balance of the 5 million in the future, then as a company, I'll give you the balance of your shares, which is 250. That's agreed. But now we are saying, suppose you will bring in this 5 million at a time when the market price is no longer 20, but the market price is 25. So we are saying, your 5 million shares will be enough only to buy how many shares? 200,000. Listen, your 5 million shillings will only be enough to buy 200,000. But, the moment you as shareholders, you bring 5 million to the company, we shall not give you 200,000. We shall give you how many? We shall give you 250. But if you have to use your 2 million to go to the market, you can only buy how many? 200. But when you bring the money to the company, we shall give you how many shares of yours? 250, which is the balance of your shares. Listen. So it means, if they bring in the money in the future, and I give them 250,000, instead of giving them 200,000, it is like, listen, it is like I am going to give them, it's like I am going to give them another how many shares for free? I have said, if they are to use their 5 million and go to the stock market, they would find one share being sold at 25. That future. That means their 5 million will only be enough to buy how many shares? 200,000. But Because we had agreed with them to buy the shares at 20, and we agreed they pay me 15, so far I have only issued to them 750,000 shares that are participating in dividend. I am now saying the moment they will bring in the balance of the 5 million, me as a company, I'll give them the balance of their shares, which is how many? 250. But their money was only enough, or will only be enough to buy how many? 200. So it is obvious, it is like out of 250 I'm going to give them, it's like I'm giving them how many for free? It's like I'm giving them another 50,000 shares for free. Those 50,000 are the ones we are going to consider as bonus shares for free. Listen, for free. Listen carefully now. It is these 50,000 shares that you are going to give them for free that will dilute the interest of the existing shareholders. It is the 50,000 shares that you are going to give them for free that will dilute the interest of the existing shareholders. Listen. So, to the number of shares you use for basic EPS, which is how many? We used 2750. Unaona hapo juu, for basic year, we used number of shares are how many? For basic EPS, we used weighted average number of shares, 2750. Now we are saying to compute the diluted earnings per share to the number of shares used for basic EPS, which is 2750, you add the bonus share element only. You add the bonus share element only. Not the 250 that you are going to give them in the future. No. Not all of them. Not all the 250,000 shares are going to be considered as dilutive. Get the point? Not all of them are considered to be dilutive. Only the bonus element in them. And I've said, how do you get the bonus element out of the 250? We have said, the moment they bought the 1 million shares, which was in January as per the case, that time, not all of their 1 million was participating in dividend. Only those which were considered to be fully paid. How many? 750. I have said, in future, they will bring the balance of their shares. They will bring in the balance of their shares. And as a company, we shall give them. They will bring in the balance of their money, In future, they will bring in the balance of their money, which is 5 million. And I'm going to give them the balance of their shares so that everything of the 1 million now can participate in dividends. So I'm going to give them another how many shares? 250,000. But I've said, suppose they will bring in the 5 million at a time when the market price per share has increased to how much? To 25. So if they use their 5 million to go to the stock market, they would find one share being sold at 25. So their 5 million shillings will only be enough to buy 200,000 shares. But if they bring their 5 million to the company, we shall give them the balance of their shares, which are amounting to how much? 250. But their 5 million was only enough to buy how many? 200. So it is like out of the 250, it's like I'm going to give them another 50 for free. Those 50,000 are the ones considered as dilutive. Remember, that's what I've said. Then I've said, to the number of shares used for basic EPS, add to the number of shares used for basic EPS, add the bonus share element. Add the bonus share element in the partly paid shares. That's what we have got as an amount of 50 added to the 2750 that we use for basic. So for now, use 28 for purpose of dilution, 2.8 million. Listen. When these shareholders will bring in the 5 million in future, or had they brought Listen, had they brought the 5 million shillings by the end of the year, it is obvious our earnings would not have changed because they're only paying a debt. So nothing in the income statement would have changed. So when we were computing basic EPS, we used the 10 million as our earnings. But even if they bring in the balance of their 5 million shillings, even if they had brought in the balance of the 5 million shillings by the end of the year, our earnings would not have changed. There is nothing I would have saved. No. Because they are only going to be paying a debt. And therefore, listen, just like stock options, which don't affect the earnings. I hope you remember, just like stock options, which don't affect the earnings, we are also saying partly paid shares don't affect the earnings. Because even if they pay me the balance of the 5 million, my earnings will still not change. Nothing in the income statement will change. No. So our earnings don't change. So when I'm computing the diluted EPS, whatever I use for basic EPS as the earnings, which is 10 million for this now, we still use 10 million. That is now when you are computing the diluted EPS now. Use 10 million. Now you divide that by the number of shares for purpose of dilution. And I've said use the number of shares used for basic EPS plus the bonus share element in the partly paid, which was 50. That comes to 2.8. So what would be the diluted EPS? It would be 10 million, divide that by 2.8 million, divide that by 2.8, that gives me 3.57. What was your basic? Our basic was up there, 3.64. Now we are saying, because of the partly paid, it is possible your earnings could be diluted to 3.57. That becomes the diluted EPS. Okay? Now, I hope you have noted that for partly paid shares to be considered to be dilutive, there is a condition that must be met. What is that condition? For partly paid shares to be considered to be dilutive, listen, for partly paid shares to be considered to be dilutive, what is the condition that must be met? That there must be, listen, there must be an increase in the market price per share since the date of the issue. There must be an increase in the market price per share since the date of the issue, which in our case we are assuming to be 25. If the market price had remained 20 by the end of the year, then it means they would still bring in 5 million to the company. Listen, if the market price still remained 20, they would have still brought 5 million to the company. I would give them their 250,000 shares. Listen, I would still give them their 250,000 shares. But even if they had used their 5 million shillings to go to the stock market and bought the shares at 20, they would still buy 250. If they bring the money to the company, I give them the balance of their shares, 250, because I'd already given them 750. If they bring it to the company, I give them the balance of 250. If they use their money to go to the stock market, which is 5 million, they would find the shares being sold at 20. They would still buy 250. So either way, there is nothing diluting out of the 250. There is nothing they are going to get for free to dilute the interest of the existing shareholders. But we have said, if the market price per share increases since the date of the issue, then, listen, whatever balance they would have brought to the company, which is 5 million, once they bring it, I will give them the balance of their 250,000 shares. But if they had used their 5 million to go to the stock market, they would buy 5 million, divide by 25, they can only buy 200. So when they bring in the money to the company, I give them 250. Instead of giving them 200 as per the market price, instead of giving them 200 as per the market price, I'll give them 250. So it is obvious as a company, it's like we are giving them an extra 50,000 shares for free. those 50,000 shares are the ones considered to be dilutive. Okay? So in summary, we are saying partly paid shares are considered to be dilutive only when there is an increase in the market price per share since the date of the issue. Since the date of what? The issue. Sawa. That's number one. Then I've said, when you're computing the diluted EPS, the earnings used for basic EPS will not change. The earnings used for basic EPS will not change. But I've said, to the number of shares used for basic EPS, you add the bonus share element in, the partly paid shares. Okay? So now I am through with the fourth one. We go to the last one. And the last one was which one? The last one, we are through with the partly paid. Now we go to contingently issuable shares. Your company has a contingently issuable agreement. Let me explain it. Your company had 2 million shares by the beginning. End of the year, the earnings are 10 million. Listen, the earnings are 10 million. We have promised our employees or our managers, listen, that we can give them 1 million shares. We shall give them 1 million shares if the market price of our company shares goes to 20 shillings. Maybe currently it's 10 shillings. And we are saying to them, if the market price hits 20 shillings per share, we as a company, we shall give you 1 million shares. Or we tell them, if the profit of the company hits to be 20 billion, if our profit hits to be 20 billion, you as managers, we shall give you 1 million shares. Now listen. Our basic is 10 million divided by 2, because there are no shares that have been issued. No, we are only promising the managers, if the market price goes up to 20 shillings, we shall give you 1 million shares. Or we are telling them, if our profits exceed 10 billion or 20 billion, we shall give you 1 million. So basic is 5. Listen now. Listen. So now that we have contingently issuable shares, and I defined contingently issuable shares, we say these are shares issuable if certain conditions are met. If certain conditions are met. I told you maybe those two conditions, profit exceeding or market value exceeding, whatever. Now listen. Contingently issuable shares are considered to be dilutive. They are considered to be dilutive if number one, the conditions have been met. The condition has been met. If the condition has not been met, then you will not issue. So they are not going to dilute. But if they have been met, the condition has been met, then you are supposed to give the shares for free. 2, they are considered to be dilutive if by the end of the year, the shares have not yet been issued. Not yet been issued. That means they are not in the system already that you use to compute the basic. They are not in the system. Because if they're already in the system, you must have, or if you have already issued them, they must have already been used in the computation of the basic. But if you have not issued them, and your basic is 5, then had you issued them, then the basic would not have been 5, would have been a particular amount. So we are saying for shares which are contingently issuable shares to be considered to be dilutive, 1, the conditions must have been met. 2, the shares have not yet been issued. For contingently issuable shares to be considered to be dilutive, then the condition must have been met, and number 2, the shares have not yet been issued. So that's all. Otherwise, again, the earnings will not change, but to the number of shares used for basic EPS, add the shares. Why? Because you are going to give them for free. Just add the number of shares. Okay? But our earnings will not have changed, because you have only told the managers, if our market price hits to be 30 shillings, we shall give you 1 million. So, whatever the case, our earnings will not change by the end of the year. But had we not given the shares, then we shall have to give if the condition has been met. So it means the number of shares would have changed. So to the number of shares used for basic, add the shares to be issued. But if the condition has not been met, then they are not considered to be dilutive. So in simple, we don't even need to do an illustration. I have said for contingently issuable shares, they are considered to be dilutive if the market condition has been met, whatever the condition. Number 2, the shares have not yet been issued. Okay. So that's all for those potential ordinary shares. I called them also dilutive factors. We have discussed how to use each of them to compute, how to use each of these items. That is number 1, number 2, number 3, number 4, and number 5, how to use them to compute what we are calling the diluted earnings per share. Let me summarize as we finish. Number 1, for convertible debentures, we have said to the earnings used for basic EPS, we said you add the debenture interest to be saved, net of what? Net of tax. I hope you remember. Then I said, to the number used for basic EPS, to the number of shares used for basic EPS, add the number of shares to be issued. Still on the same, we have said, if the shares were issued, if the debentures were issued in between the year, then the conversion is assumed to be with effect from the date of the issue. That means the interest you would not have paid for the full year, we were assuming you issued the debentures on July, so you paid only interest for 6 months. So your interest to be saved is for 6 months, net of tax. The number of shares to be issued must be weighted for those 6 months. That means must be weighted on time basis. That went. The second one was convertible preference shares. I have said, when you have convertible preference shares, how do you use them to compute diluted EPS? We have said, to the earnings used for basic EPS, add the preference dividend that would have been saved, the preference dividend that would have been saved. This time you don't say net of tax. No. Why? I told you preference dividends are not subjected to tax. They come after tax. So you don't subject them to tax. Then I told you to the number of shares used for basic EPS, add the number of shares to be issued on conversion. Then I told you, if the preference shares were issued in between the year, then the conversion is assumed to be with effect from the date of the issue. So, the preference dividend, you did not pay for the full year, you only paid for 6 months. Then I've said, the number of shares you would have issued, which we were assuming to be 1 million, you would have multiplied that by 6/12. In other words, they must be weighted. Why? Because had they converted in July, they would have been my shareholders for only 6 months. Good. Then now, number 3, we have said, stock option. Tumesema, when it's a stock option, the earnings for basic EPS will not change. Don't forget, the earnings for basic EPS will not change. Then I've said, to the number of shares used for basic EPS, you now add what? We said you add the bonus share element in the stock option, the bonus share element. These guys will buy 1 million shares at 15. So they will bring in 15 million, we shall give them 1 million. But their 15 million was only enough to buy, how many? Was only enough to buy 750. You remember? Which is 15 million divided by 20, 750. But we shall not give them 750, we shall give them 1 million. So out of the 1 million, 250 are going to be considered as bonus for free. That is going to be dilutive. So to the number of shares used for basic EPS, add the 250, which is bonus. That has gone. Then I've said the numerator earnings will not change. Number 4, partly paid. We have said partly paid shares are considered to be dilutive only when there is an increase in the market price per share. Okay? Then I've said when the shareholders will pay me the balance of the money, our earnings will not change. Our earnings will still remain the same. But I've said, because the market price has changed, they will bring in the 5 million, we shall give them the 250,000 shares to consider the 50,000 shares, 250,000 shares balance of their shares. When they bought the 1 million, out of the 1 million they bought at 15, they paid 15, which means out of the 1 million, only 750 were participating in dividends. When they bring in the balance of 5 million, I have said we shall give them the balance of their 250,000. That's what we have said. But we have said, because the market price has grown to 25, and they'll bring in the 5 million, when the market price is 25, their 5 million will be enough to buy 250. But as a company, we shall not give them 250, we shall give them 200. We shall not give them 200, we shall give them 250. When they bring in the 5 million, we shall give them the balance of their shares, 250, while yet we should have given them 200. So it's like we are going to give them an extra 50 for free. That's what we have said. So those 50,000 are the ones considered as bonus. They are the ones to add to the number of shares used for basic EPS. Finally, contingently issuable shares. They are only considered to be dilutive only when 2 conditions are met. 1, the condition has been met, and number 2, the shares have not yet been issued. The shares have not yet been issued. Now listen, because we have no time, next lesson we shall look at another scenario. Listen now. In your exams, you are normally given a scenario whereby you began the year with 2 million, nothing happened during the year, but by the end of the year, your company has a 10% convertible debenture. At the same time, your company has a 10% convertible preference. At the same time, your company has a stock option of 1 million shares at a price of 15 when the market price is 20. In other words, listen, in other words, what we have been doing before, we have been assuming there is only one potential ordinary at the end of the year, then you compute the diluted. Only one potential, by the end of the year you compute diluted. But now what we shall do next time is this. When your company has more than one potential ordinary share at the end of the year, more than one, like in our case, we have 3. Yes, the earnings were 10 million. So your basic was 10M divided by 2, that comes to 5 shillings. That was your basic. But your company has a 10% convertible, your company has a 10% preference, your company by the end of the year also has a stock option, by the end of the year. How do you use all these items? How do we use all these items to compute what we are calling the diluted earnings per share? How do we use them to compute the diluted earnings per share? That is what we shall use, or what we shall do next time, where we shall ask ourselves, when you have more than one potential ordinary share, how do you use them to compute what we are calling the diluted EPS? Listen, for these potential ordinary shares, we shall have to be ranking them. We shall have to rank them and find out which one of them is more dilutive than the other, and so on. So that is what we shall discuss next time. So for now, we can stop there. We pick it up from there next time. Where we shall now discuss. Same rules will follow. The concepts are the same, but now we want to use many potential ordinary shares at the same time. But the concepts still change. For debenture interest, interest. For debenture preference, preference dividends, and so on. For stock options, bonus shares, and so on. The concepts still remain the same. The only issue is we have more than one potential ordinary share. That's what we shall discuss next time. So see you next time. Okay.